What's going on, everyone, and welcome to your financial dose. My name is Julian, and this channel is all about helping you guys master your personal finances. And today, as promised, what we're going to do is we're going to compare the tax-free saving account and the RRSP, and we're going to say, well, okay, after 40 years of working life, which investment scenarios will let us come out ahead? Is it solely investing in the tax-free saving account, solely investing in the RRSP, or would it be investing in a mix of both? Stay tuned to find out more. Okay, so now we're going to be looking at the model that I created to sort of make looking at all these numbers a little easier. So we're going to be looking at the blue, the yellow, and the orange scenarios at first, and then we're going to go further down and we're going to look at the different outcomes 1, 2, 3, and 4. So to begin, we're going to look at if we contribute everything to the RRSP. So now I'm assuming that we're in 2020, we're working and we're making $75,000 per year. That's what we see here. Okay, income at retirement, this is just one of the scenarios, but actually we don't even need this. So let me just get rid of this row here. And now, so in Quebec, the marginal tax rate at $75,000 is 37.12%. And we're going to assume that we're going to be contributing $10,000 to our RRSP in 2020. So if we're looking at our after-tax income before contribution, we're going to be looking at $52,124. After a $10,000 contribution, since we're going to be getting back $3,700 approximately, we're going to be looking at an after-tax income of $55,836. So the government gives us back $37,12 after we put $10,000 into our RRSP in 2020. However, since we're getting this money back, I'm saying let's put this $37,12 back into our RRSP, and then we'll get another $1,377 back. And I'm just saying, okay, well, we're going to do this process twice, and we're going to assume that this all happened in 2020. Because normally, once you get the money back from the government, and if you wanted to recontribute that $37,12, it would count as a contribution for the following year. But since I really wanted to simplify things as much as possible, I just assumed that, okay, we'll recontribute this $37,12 today, and we'll get the money right away, and then we'll contribute the $1,377 back into the RRSP, but we're not going to add to the model what we would get back had we contributed the $1,377. I hope that's pretty clear. So what we're going to have contributed overall, we're going to be doing the $10,000 plus the $37,12, which we got back from the government off of the $10,000, plus the $1,377, which is what we got back from the government after contributing $37,12. Now again, just to let you guys know, this is not actually how it works, because after we contribute the $10,000, we would get the $37,12 back, and we would only be able to contribute it to our RRSP in 2021. And then after contributing this $37,12, we would get back $1,377, which we would only be able to contribute to our RRSP in 2022. But I'm just assuming, like, I'm sort of going into the future and coming back to the past and contributing these amounts all in 2020 just to make the analysis more simple. It doesn't really change the numbers that much. So now we contributed a total of $5,088 that we got back from the government, plus the $10,000 that we initially contributed, for a total amount of a little over $15,000. This was scenario 1, meaning that we contributed all of the $10,000 into the RRSP only, and then any tax credits or tax deductions that we got back from the government, we recontributed to the RRSP. In scenario number 2, which is a little more simple to understand, all the conditions are the same, except that, yes, we put $10,000 into the RRSP, but that tax credit or that tax deduction that we get back, we actually take this $37,12 and we put it in our tax-free saving account. And since you don't get any money back from the tax-free saving account, the analysis ends there. So overall, we're looking at a total contribution of $10,000 to the RRSP and $37,12 to the tax-free saving account. Now finally, the last one, or the last scenario in orange, is simply contributing $10,000 to the tax-free saving account. Since there's no tax credits, no tax deductions, no nothing, it's simple. Our investment portfolio is going to be a total of $10,000. So we're looking at $15,000 in the blue scenario. We're looking at about $15,700 in the orange scenario as a starting portfolio, and then we're looking at $10,000 as a starting portfolio in the orange scenario. Now, for the investment period, what I'm doing is I'm saying the investment period is going to be 480 months, which comes out to 40 years, and at an 8% annual rate. But since we're going to be doing monthly compounding, you take 8%, you divide it by 12, and then it gives us 0.67% per month. No, this is not an exact science, but just to make it a bit more fair, we'll do compounding every month instead of every year, because it represents reality a little more than just taking compounding every year. Again, it's not super important that you guys understand the difference between yearly compounding, monthly compounding, weekly compounding, and daily compounding. This is just the assumptions that I'm using in my model. Again, you guys can say, oh, well, I'd rather use yearly compounding if you can understand the difference between the two. But since, to generate an 8% return, we're going to have to go invest in equity, a monthly compounding schedule should be about all right. So now what we need to do is we need to create the inputs for our formula that will calculate the future value of our starting investment portfolio in 40 years from now. So technically when we want to retire. So the formula is as follows. In the future value, the FV box, what I have is I have B14, so that's my rate. That's 0.67%. Since it's a monthly rate, we're going to be in the next article or argument of the formula, we're going to be adding the period, which is cell B13. This is 480 months or 40 years. For the payment argument, we're not going to be contributing to our investment accounts throughout the years. We're just saying this is our contribution today and we're never going to touch it again, just to make the analysis more simple. And then the PV, which is the balance that we're starting with, which is 15,089, we put negative because the relationship between the future value and the present value is negative. So we just put a negative here so we can actually have a positive future value. I'll show you what happens if you don't put the negative. And for the type, since we're not investing into the account, it doesn't matter if the contributions go in at the beginning or the end of the year. So if you put 0 or if you put 1, it doesn't really matter. So that means that in 40 years, at 8% per year or 0.67 per month, we're going to be looking at an investment account of $366,000 from this $15,000 initial balance. And the reason why it grew so much is, well, you make 8% on 8% on 8% on 8% every year, or 0.67% on 0.67% every month. So after, 480 compounding periods, this amount really grows to a substantial amount. And that's sort of the magic of compound interest. So at the end of these 40 years, we're going to be looking at a balance in our RRSP of $366,000 and a balance of 0 in our TFSA because we did not invest in our tax-free saving account at time 0 or in 2020. In the yellow scenario, same sort of specs in terms of the investing and the compounding, but the balance of the RRSP is significantly lower compared to the $15,000 balance that we had in the blue scenario. So we're going to be using $10,000 in the RRSP, and that's going to be giving us a total of $242,000 in 40 years from now. And then we also need to look at what happens in the tax-free saving account. So we have $3712 at the beginning, invested for 40 years at 0.67% monthly will then give us $90,000 in the future. Now, finally, in the last scenario, where we only contributed to the tax-free saving account, well, we did, $10,000, 480 months, 0.67%, and we're looking at the future value, and that gives us $242,733. So these are all of our balances at 40 years from now before we pay tax on any of the investment accounts. So for the tax-free saving account, that balance won't change because we don't pay tax when we withdraw. But on the RRSP, that balance will change because when we withdraw, we will be paying whatever marginal tax rate that we owe based on our income level in retirement. So moving on to the different scenarios. Now, what makes sort of this analysis more interesting is to vary the amount of income that we make in retirement to see how this marginal tax rate will actually affect the benefit of investing in an RRSP versus a tax-free saving account. So starting with scenario 1, I'm saying, well, let's say we end up making $100,000 in our retirement through either income, a pension fund, passive income, real estate, stocks, dividends, it doesn't matter. But let's say we're making $100,000 per year in our retirement. So at age, if you started your RRSP at age 20, 40 years later, we're at age 60, that's when you choose to retire, and you're making $100,000 a year. And then you're looking at your RRSP and you're saying, okay, well, let me withdraw $5,000 from my RRSP, in addition to the $100,000 I'm already making. So your total income would go from $100,000 to $105,000 after withdrawing the $5,000 from your RRSP. And the marginal tax rate in Quebec, yes, in Quebec, is very high. At $100,000 of income is 45%. So if you're going to withdraw $5,000 per year, you're going to be paying 45% in tax, which means you have a little over half that you get to keep, which isn't that much. And not all areas are going to have the same tax rate, but since I'm located in Quebec, I'm just using Quebec tax rates. But again, you'll see that as my example moves on, I vary the tax rate, and then it actually changes the result of whether or not you should invest in your tax-free or your RSP. So there's two key assumptions here. The first assumption is, well, I'm going to be making more money than the initial year that I chose to put money into my RSP. Because if we go above, we're looking at the income in 2020 was $75,000. So your tax rate is actually lower when you were working than in retirement. So if you go back down to scenario 1 at an income of $100,000 or at a marginal tax rate of 45%, if you end up withdrawing the entire balance of your RSP over your retirement, and if during your retirement you end up making $100,000 every year, excluding any withdrawals that you made from your RSP, you're looking at paying a total of $167,000 in taxes based on all of your RSP withdrawals. So what you actually get after tax for your RSP is only $198,000, because almost half of it, when you withdraw, goes to the government in the form of taxes. And again, it's important to understand that the tax rate here, the 45%, is the marginal tax rate. I'm not saying that these are the taxes that you pay on the $100,000. No, since you're already generating $100,000 of income, any withdrawal above the $100,000 will be taxed at 45%. And since your RSP withdrawals will be in addition to the $100,000, it's only important to look at the marginal tax rate. So if you withdraw, $5,000 a year or $10,000 a year, the marginal tax rate will stay around at 45%. And every year that you withdraw, it'll also be at 45%. That's why I'm just saying, let's take the full balance, the $366,000, apply the 45% tax rate, and see what's left. And what's left, the $198,000, will be withdrawn over the 20 or 30 or 40 years that you are living in your retirement. Now, moving on to our, yellow scenario here, where we actually split the investment balance, or the beginning balance, between the RRSP and the tax-free saving account. So at the same 45% marginal tax rate, we paid less taxes here at $110,000 compared to the $167,000, because we only have $242,000 in the RSP compared to $366,000, because we put some money in our tax-free saving account, which when we withdraw money from there, we don't pay any taxes. So after paying taxes on the $242,000, we're looking at $131,000 that we get after tax, plus the $90,000, which gives us a total of $221,000. So again, if we compare the two scenarios, blue versus yellow, we're looking at, a benefit of a little over $20,000 because we paid less tax, because we invested some money initially in the tax-free saving account. And finally, if we're looking at the scenario where we just invested in the tax-free saving account, so we don't pay any taxes because, it's tax-free, we're looking at a total balance of $242,000. So I guess in short, the key takeaway is, if you're planning on making more money in your retirement, I know it's a hard thing to plan, but if you end up making more money in your retirement, it's more beneficial to invest in the tax-free saving account than the RRSP, because your contributions will be made at, say, a 37% marginal tax rate, like here, because you're only making $75,000. But all the withdrawals will be taxed at 45% because we're assuming we're going to be making more money in the future. Now, scenario 2 is keeping the marginal tax rate the same. So if you're generating, $75,000 of income in 2020, in 2060 when you retire, you're going to be generating the same amount of income in retirement. So the marginal tax rate will remain at 37.12%, which is the same that it was in our initial scenarios because we're making the same amount of money. So any withdrawal that we make above the $75,000 mark will be taxed at 37%. Again, we're looking at the amount of taxes we pay, $135,000, and then the balance after tax is $230,000. So if we only contributed to our RRSP, again, you see how the decrease in tax rate means that we have about $30,000 more compared to scenario 1 because our marginal tax rate is lower. Again, moving on to the yellow scenario where we split between the RRSP and the tax-free saving account, we're making $242,000. And if we only go into the tax-free saving account, we're also making $242,000. And the reason why the two scenarios are the same here is because when we were working, our marginal tax rate was 37%, and in retirement, we have the same marginal tax rate. So it doesn't really make a difference. And here in scenario 2, where we only invest in the RRSP, the only reason why it's not equivalent is because technically, as I explained at the beginning of the video, when we take the $37.12 that we initially get from our initial contribution and we contribute it again to then generate another $1,377, I said we'll stop it here. But this technically can go on for like 10, 20, it could go on forever because then you take the $1,377, you contribute again, you get money back, and then you do that the next year and the next year and the next year, and that amount will decrease until it becomes quite insignificant, but that'll take 10, 15 years. But I didn't include those numbers in the model. I just said, let's do this for 2 years and let's see what happens. So that's why you have $230,000 instead of $242,000. But we can assume that since the tax rates are the same, these three amounts should all equal to the same amount. Now, moving on even lower, in the third scenario, when we're saying, okay, with a $50,000 income, and a 27% marginal tax rate, what happens to our numbers? Well, for the first time, we can see that the tax-free saving account, which always generates $242,000 because it's not impacted by our marginal tax rate, is no longer the most beneficial one. The most beneficial one in this case would be the mix between the RRSP and the tax-free saving account. And as I explained earlier, if we would have kept reinvesting what the government gave us back in tax credits, and took that all back to 2020, then scenario 1, that is currently slightly below scenario 2, would be the most beneficial. But again, you don't know if you will always be reinvesting those government tax credits because life conditions may change. So I think it's fair to say, well, if you invest the initial $10,000 into the RRSP, you take the tax credit and you put it in the tax-free saving account, you come out on top in this case because you have $266,000 after tax available to you, compared to the $242,000. And the reason why this happens is because our marginal tax rate is lower in retirement than what it was when we were working, because we're looking at 27% as opposed to 37%. Finally, in scenario 4, where in Quebec, it's very hard to be making a 20% marginal, to be in a 20% marginal income tax rate. So I didn't even bother putting an income in retirement. Let's just use the marginal tax rate. Because if you're in the States and you pay less income tax, this is going to probably be closer to what you're going to be paying than, 47%. Depending, of course, on the amount of income that you make. So on the initial balance here of $366,000, we're only going to be paying $73,000 in tax throughout our retirement, leaving $293,000 available to us in our retirement. If we look at the hybrid option between the two, we're looking at $284,000, and if we look solely at the TFSA, we're looking at $242,000. So again, this sort of solidifies the fact that if your marginal tax rate is going to be less in retirement, then contributing to an RRSP does make sense. And I highlighted two rows or two partial rows in red to show you sort of how much taxes you save and how much taxes you end up paying. So in 2020, when you contribute the $10,000, and then you contribute the 37, and then you contribute the 37 to get back the 1377, your total tax savings are about $5,000. In your retirement, after withdrawing your full RRSP at the marginal tax rate of 37%, you end up paying $135,000 in taxes. So the government's saying, look, I'll give you a tax break today, but in the future, when your investment portfolio grows thanks to compound interest, I'm going to tax you then. And people think that's a great deal, but look at the difference in taxes that you end up paying. You go from $5,000 that you've saved in taxes to paying $136,000 throughout your retirement over, say, 20, 30, or 40 years. It's not so important. What's important to know is the taxes that we pay is so much more because we ended up with $366,000 as opposed to $10,000 or $15,000 after taking into account the taxes that we end up getting back from the government. So that's also something that you guys need to keep in mind when you're comparing the tax-free saving account to the RRSP. So I know this video was very heavy because it was very number focused, but I think it was important to actually look at scenarios to try and figure out, well, should I invest in my tax-free saving account first, or should I invest in my RSP first? And again, you need to look beyond numbers sometimes because, as I mentioned in my previous videos, investing in the tax-free saving account is great because it's flexible. You can pull money out, you can put money in whenever, and you don't have any restrictions. When you're talking about the RSP, you can only pull money out in very specific scenarios, and you need to sort of put that money back in over a certain period of time. Otherwise, if you take the money out early, you lose any benefit that you've got in the RRSP. And again, these two accounts are better than investing in a non-registered account because all the capital gains that you make within the account while trading or while investing, or all the income that you would make through buying bonds or dividends, aren't taxed. They're only taxed when you withdraw. If you're investing in a non-registered account, then any income you make, anytime you sell shares and you make a profit, you will need to pay taxes in that current year. So you don't get to defer taxes to either when you retire, so when you start withdrawing the money, or in the tax-free saving account, you'll never pay taxes on the income that you generate because it's a tax-free saving account. So in short, if your marginal tax rate is going to be lower in retirement than it was when you were working, it's a good idea to, contribute to your RSP and to contribute to your TFSA just because of the added flexibility that you have. If you're able to fill up both accounts, then great. Obviously fill them both up. But if you're guaranteed that you're going to be making less money in retirement, maybe it's better to fill up that RRSP first. If you're unsure as to whether or not you're going to be making more money or less money, because if you've lived, a financially successful life and you have a lot of investments and you're generating a lot of income in retirement, then maybe it's better to invest in that tax-free, or to fill up that tax-free saving account first because of the added flexibility and because you won't be paying taxes in the future when you withdraw. And since you're going to have much more money in the future, as I showed in my example, it could be beneficial to you, especially if you're maybe expecting your marginal tax rate to be higher. So yes, it's very hard to predict what your income is going to be in the future, but I think it comes down to what your mindset in life is. If your mindset in life is to grow your nest egg, to grow your wealth, and start a business, for example, and then when you retire, that business keeps generating money even though you're not working in it every day, then I think the tax-free saving account is much more viable for everyone because of the flexibility that it adds and because of the pure tax-freeness that you get while investing in it. If you're going to live a more conventional life where you work, you at a company for 40 years, you get a pension and everything, and you retire, but you retire with less money than what you were making while you were working, then I think definitely the RSP is a great tool, or it's much better than not investing in anything or investing in a non-registered account. But I personally enjoy the freedom that the tax-free saving account gives to you, because if you want to, buy properties, you can just sell whatever you have in your tax-free, take that money and buy a property, like an investment property. But if you wanted to buy a property and all your money was tied up in the RSP, you can't really take it out without paying a penalty. Well, guys, again, thanks for watching. This was very heavy. I hope you learned something. As usual, if you like what I'm doing, if you like the content that this channel is creating, if you feel like you guys are learning something, please subscribe to my channel, give the video a like. It really helps me out and encourages me. If you have any opinions as to what I said, or if you have recommendations as to where people should invest, please comment below and we'll all see. I'll get back to you as soon as I can, and see you in the next one.